You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. Today's podcast, Bill Chen from Rhizome Partner Returns. Bill is one of the most popular guests on the platform. He's got a deep expertise in all things real estate, publicly and privately traded. He went to NAREIT, I believe it's called. I never know if it's NAREIT or NAREIT. I'm not a full-time REIT person, but he went last week and we just dive into all things REIT. We talk, apartment REITs, New York REITs, San Francisco REITs, the stress REITs, public real estate, private real estate, everything that you can imagine. Bill's got a great source of info. I think you're really going to enjoy it. We dive into everything. We go for almost an hour and a half. So we're going to get to that in Bill Chen in 1 second. But first, a word from our sponsors. Today's episode is brought to you by FinTool. FinTool is the AI junior analyst tailored specifically for individual investors. Everyone in finance is racing to figure out how AI can best be integrated into their investment process, and one of the biggest areas that is catching on with institutional investors is analyzing SEC filings and earnings call transcripts. FinTool takes hours of combing through filings and control-Fing transcripts down to seconds. Whether it's comparing the current call with prior quarters, finding that sneaky change in the footnotes, or compiling the key facts into an easy-to-digest one-pager, FinTool is saving you hours so that you can go deeper and search wider, because your time is better spent turning over more rocks or researching the things that AI can't. Go to fintool.com to transform your research process. That's fintool.com. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me, I'm happy to have on Bill. I don't even know what time it is, but one of the people's favorite guests. Every time he comes on, I get lots of emails about people love hearing about the nuanced real estate takes, the overall real estate takes. Anyway, my friend and the best cricket player I know, Bill Chen from Rhizome Partners. Bill, how's it going?
Great, man. Andrew, good. Always, great to be on your podcast. Love to connect. And just correction, croquet, not cricket. No, nothing about cricket.
Yeah. Get him on a cricket field.
And I remember my hat. Happy Father's Day to you.
That's what I was going to say. Most people listen on audio, but this might be a YouTube podcast for everyone. Not because we're going to have any slides, because I've got my number one dad hat with Sylvie's handprint right on the side of it here. And Bill's got the elusive Yet Another Value podcast hat on, at least for now. But look,
Bill,
at
least for now. I'm taking it off because it's I have one of the world's largest heads, and it doesn't look right on me. But yep.
Bill, we have a ton to talk about. I think the overarching reason that you're coming on is we had you on about a year ago. You went through a ton of stuff in real estate, and I think a lot of it's like kind of played out as you kind of thought it would. But the reason we want to have you on today is you went to NAREIT a week or two ago, and we're just going to do an overall discussion of all sorts of stuff in the real estate sector. So before I turn the ball over to you, I'll just remind everyone, quick disclaimer, nothing on this podcast is investing advice. We're going to talk about a host of names today, so keep that in mind. There's a full disclaimer on the website and at the end of this podcast. So with that all the way, Bill, you're just back from NAREIT. I know you specialize on real estate. I know you think things are really interesting right now. So I'll just kind of pass the ball over to you, and then I'll sprinkle in some questions as you go.
Sure. So we met with a dozen management teams at NAREIT this year, and there's a huge contrast. We track both the public market and the private market, and what we're trying to do, like you remember, our core strategy is we want to buy stuff in the public market at a deep discount to private market valuation, and we track. We follow a lot of real estate GPs. We get kind of real time updates to private deals. And the sentiment is very, very different at NAREIT. At NAREIT, the key takeaway is, of all the companies that we met, none of them are dealing with any sorts of distress. None of them have any issues rolling their debt. All of them are covering their interest expense anywhere from 3 to 8 times, which is very, very different, right? On the private side, from a new debt underwriting perspective, the debt service coverage ratio starts at 1.25, and that's considered, anything above that is considered healthy. We just did the math for Mid-America. The interest coverage ratio is 7.2 times. For Camden, 6.8 times. I mean, there's just there's no scenario, unless they go out and do some big risky deal, which they're not going to. There's no scenario that these companies become trouble, right, based on those coverage ratios. And a key theme is a lot of the public REITs, especially the bigger blue chip ones, are they're getting excited because consistently across all themes, and this is something that we were pounding the table in late 2023, saying, in today's interest rate environment and the appetite and what you would underwrite to a development IRR, it doesn't make any sense to develop new projects. And we kind of predicted in late 23 that construction, what is, planned and budget for, will get done, will get completed. But, fast forward kind of 18, 24 months, that construction is going to fall off a cliff. And you see that. You could see that in particularly multifamily. And we're seeing 70-80% drop off in market rate starts for multifamily. There are some affordable, mission-driven projects being greenlit, but aside from that, like the market rate apartment units have fallen off. Depending on who you talk to, 70-80%. You're seeing it in self-storage. If you look at a chart on warehouse starts across the board, you're just seeing construction activity fall off an absolute cliff. Anywhere from call it minimum 50% to up to like 80% in most asset categories. The only asset class that are still getting the green light to build is data centers, and that's a different thing.
You didn't even need to finish the sentence. Yeah. I knew what you were going to say. Yeah.
So they, AI data centers, that's a whole different animal. So, but what's really interesting is kind of what we were saying consistently for the past 18 months is that these blue chip REITs have the balance sheet. And they have access to the unsecured bond market. And there's been multiple unsecured bond offerings anywhere in that. I think the lowest we saw was 4.9%, upwards to like mid 5, some of the lower rated, maybe like a little bit in the high 5 range. They're able to issue 7-year fixed rate unsecured bonds into the market. And then what they could do is they could use that money to go do ground up developments. And from a lender perspective, the lenders, who are buying these unsecured bonds, they're not thinking, oh, I'm lending 100% of this money to do a risky one-off ground up development deal. The lenders of these unsecured bonds are thinking, well, I'm lending into mostly a 95% occupied, stabilized portfolio with lots of assets, hundreds of buildings into a REIT. And then they could take, a portion, kind of like a 5 or 6% of that overall capitalization to go do ground up developments. So it becomes this, cost of capital arbitrage. And Mid-America and Camden are both, very, very excited about pushing that. And we particularly as Mid-America, hey, instead of a $1.2 billion development pipeline, why don't you push it to $2 billion? Now, granted, this is like a $22 billion enterprise, $23 billion enterprise value company, right? So there are limitations. There are kind of like a lot of these REITs kind of have to play in a certain box where they can't have too much developments, but all of them are flexing their development muscles, and they are also looking for acquisitions. So that's a consistent theme where they're saying, hey, if we could buy a brand new multifamily building that we're going to hold for 25 years, even if we buy it at a 5% cap rate, rent growth, in 26, 27, 28. And generally, the assumption is that rent growth, supply is either fully absorbed right now or in the next 3 months will be fully absorbed. There's like certain select markets like Nashville and Austin still have some supply issues, but most of the Sunbelt have kind of fully absorbed this supply wave. And most of them are excited about rent growth. Like, what could that be? I think minimally probably 3% per year going forward in 26, 27, 28, and you're really not going to see a lot of supply come onto the market, probably at least until like the second half, 28, 29. The longer that we're in this higher interest rate environment, the longer that's going to exist. So a lot of these bigger REITs are kind of excited that they're in a pretty good position, that they're in a much more advantageous position. We ran, I saw that you tweeted out, a few people have asked, what do we think the forward IRRs are on some of these names? In our model, if you hold it for 3 years, we have call it like roughly 18% IRR. If you hold it for 4 years, we're modeling like a 15% IRR. This generally assumes kind of 3-4% rent growth in the next 3 years, a 5% exit cap rate. And nothing like super crazy. And then whatever they do from a capital allocation, from ground up development and acquisition perspective, kind of becomes like the other variables. But so like, let me
jump in there real quick. So
yeah,
this is the same every time we come on. We have this session, but for people who haven't listened to prior episodes or something, like the big assumption in that 18%, 15% IRR, which, I mean, you're talking liquid large caps with a great dividend yield, doing mid-teens IRRs. I mean, that's the stuff of, and you were arguing this the last time you were on, and they've done great since then, but that's the stuff of, hey, forget everything else and like plop it, it's not Warren Buffett in the 60s, but it's really good. 15% over 5 years would make anyone's career very nicely. So the big assumption in there is a 5% exit cap rate. And I just want to push at that a little bit. Like, they're going out. What are they buying when they're looking at acquisitions? What are they looking at acquisitions?
So they're generally, if they're buying something that's brand new construction, they want to be able to buy that at a 5% cap rate. Now, Andrew, you may say, well, Bill, like, they're buying at a 5% for brand new. This is not a brand new portfolio.
That's what I was going to say.
There you go. I'm anticipating. Well, I think what's important is that you have to realize that they're willing to go buy that at a 5% cap rate because obviously they think that that's a great deal, right? And think about like who has the capital. I mean, maybe aside from like KK or Blackstone, like there's not all the private buyers essentially are out of the market, right? Like if you are forced to sell a brand new ground up development at a 5% cap rate, you're likely in a position where you have to sell. Most people, most developers, like if they could, they would continue to hold this until at a time where they could exit at a better price. So, keep that in mind, right? Like just simply because you see something transact at a certain price, especially if Mid-America Camden is buying at a brand new at a 5 cap, doesn't mean like that's like truly, right? Like where the market is. And also like just kind of going back to, okay, well, this is not a portfolio. This is not like 1 or 2 year old. This is an older portfolio. But I think there is something about like, the publics have been trading at a discount to private for a really, really long time. But when you and this is not always the case, right? David Swenson famously coined the term, liquidity premium. Like there is historically should be a premium. And I think we're about to go into a period where investors today are not paying anything at all, right? You're not paying anything at all for that optionality. Like I would make the argument that if you got a cost of capital advantage, you're large, you're liquid, you're diversified, you should trade at a premium, especially if all the private players are kind of, got their hands tied behind their back because they can't do anything. And then these guys become like the acquirers, right? Like these assets should trade a premium. And then I think also just from like a capital allocation perspective, both Mid-America and Camden has been kind of like plodding along for 2 years where they're either slightly negative, NOI, there's a little bit of NOI decline or flat NOI decline. We're about to kind of go through like a 3-year period. Likely we're modeling kind of like 3% NOI growth. And I think like the algorithm will kind of pick up on that. And also just like it becomes like safe for some of the REIT dedicated firms, funds like your Nuveen, your Cohen Steer to say, hey, like this is quote unquote investable, right? And that is our strategy. Our strategy is our LPs give us patient 3-year capital for us to be able to kind of stick, stay with a thesis, right? As long as we're right in it, right? And then like there's all the market participants who's like, oh, we can't, own this going into if NOI is going to drop even just 1%, right? So I think a lot of that is going to potentially come back, and it's important to kind of think through on like where the new buyers are going to come from, and I think a lot of traditional REIT investors are going to start to overweight, these names.
Let me ask you a weird question. You were at NAREIT. It's in NYC. You live in NYC. I live in NYC.
Yeah.
We've got the mayoral race coming up right now. And I know a lot of my friends who are pulling their hair out over the predicted markets and who's running in second place. Obviously there's a huge political factor, but even ignoring that, we've seen, and you and I've discussed, you've seen the issues with rent control. You've seen issues with huge increases in operating expenses, all this sort of stuff. What were you hearing? And this doesn't just apply to resi, though. Obviously, I was thinking about resi, but the overall issues with New York City apply to all of your big office building companies, lots of people with retail exposure, everything. What were you hearing about New York City real estate specifically at NAREIT?
So specifically at NAREIT,
Or just in general, just
okay.
your general thoughts. But yeah.
So um, what's interesting is that Andrew, we did a podcast, I guess like 2 years ago on Clipper, right? And at the time, we still had a lot of that COVID hangover, and I remember like Vornado was $12 at that time, and people still thought that people, New York City is like kind of like it has it fully recovered, has it right? And this is the first time that we heard that, oh my god, like the fundamentals in New York is just it just everyone loved New York City exposure from like a health of rent growth, just the fundamentals, et cetera, et cetera. And
Was this
that
across the board, office, retail, real estate, or were people
no,
making
this is
any
particularly
exceptions?
like in residential. Now
Okay.
this says nothing about like the political conversation, right? Like I think that what we've been kind of pounding the table about New York and New York City, and why we love New York City so much is that you can't really build anything here, and then all this crazy rent regulation makes it even harder for developers to develop because you're developing into this extremely uncertain environment. So what we've been hearing from the conference is like the equity residentials, et cetera, of the world. They're just kind of like talking about how much they like the New York City or the New York, like kind of like the tri-state adjacent, how strong that the fundamentals are there. Now politically, there's a separate conversation about like this the mayor candidates and some of these forever rent freeze, the government back, supermarkets, et cetera, which like I don't like to get political, but like I came from a communist country, and I just hate it. Like if we're going back to another price control environment, right? Like this is so.
Hey, look, noted. It's not like the New York Times is the Wall Street opinion board, but I did see this morning that the New York Times like, look, all the candidates, we don't really like any of them. We're not endorsing anyone, but we would specifically say like these proposals are crazy, and the background here is not what you'd want in someone who's going to run 300,000 employees. So we would specifically recommend you leave the candidate you're talking about off the
Oh,
ticket. Yeah.
I did not see that. It's a little bit surprising to see the New York Times, come out with something like that. Yeah.
Because sometimes like, oh, is this just my super right leaning, like really conservative finance friends who are freaking out about this, and like, am I crazy to be freaking about it? And then you see the New York Times like, no, this is pretty crazy.
Okay, this is okay. Well, I mean, to kind of give you a little bit of context, like we're very much in the weeds in multifamily and regulation all over the country, right? And if you look at a market like Washington, D.C., where they kind of pass all these regulations where basically can't evict people. And then what they found is that the affordable housing providers, the developers, and the mission-driven providers, they got themselves into financial situation where these are people who are building the affordable units. I can't recall any names right now, but like if you can't evict people and people just decided not to pay rent, then there's moral hazards involved, and these are the really good Samaritans, the people who are building affordable, and they're going to go out of business and they have to file for bankruptcy. I think that was like a wake-up call for politicians, and they say, look, you can't just pause rent growth, et cetera, et cetera. But like, we probably should have make this conversation into like a, like a rent
I was
regulation.
just curious because it's topical, and you were
Yeah.
there, and I was wondering, like, as you're saying, it seems like New York City fundamentals have really turned around, but I was wondering if the people who are going to be most impacted are the people who own New York City real estate. So I was wondering if they were indicating any hesitation, or hey, we're going to wait to buy new properties until we see what this looks like, or if they're just like, look,
I mean, if you think about it, like from what we heard is that like the big REITs, with the exception of Clipper actually has some rent regulated exposure, right? The bigger boys, the Allen Bay, the equity residentials of the world, they their units, like I think I wouldn't say there's like zero rent regulation, because
Avalon Bay is like a very fancy apartment too.
yeah, I mean they're much higher end. So in a way they may even be like doing this and be like, oh, like you're gonna put in rent regulation, like our assets are gonna be worth more because like from a long-term development perspective, there's going to be very little being built, right? So,
Yep.
so that's we were a lot more focused on some of our names like the Sunbelt, and then we could take the conversation back to Sunbelt. In the Sunbelt markets, I mean, it seems like there's a lot of political will to not impose rent regulation in these markets, in these Sunbelt markets. And I think, population growth continues to be a trend. And so we're kind of, by the way, Andrew, I did a little, like one thing that we do sometimes with our investments is that we like to look at what we said, like our underwriting, and we like to do a little bit of compare what has actually happened versus our stated thesis. And we ran that.
It's a postmortem. It's a good practice. Yeah. I generally don't like to do that because I don't like to see how terribly wrong I was, and I rub my nose in it already. But it is a good practice.
No, it's good practice, and then it's also like the stated theme versus like what's actually happened. So far, it's tracking. Usually, when we know we're tracking a thesis, we gain more confidence that we know the situation, and I crunched some number. I crunched some numbers. Late 23 when we did the podcast, if you would have bought between 115 to 130, right? And how they tell today IRR is between 14.7 to 24, 22. If you would have sold it recently between 155 to 170, IRR would have been 17 to 38, right? So it's all the big gaps in range, but the bottom is just a hair under 15. And it kind of gives us a little bit of confidence that, hey, if we kind of got the thesis right, I think on a 3-year go forward, we're underwriting to somewhere between 15 for 4 years, 18 for 3 years. And we stick this. And this is one of the bigger part of our portfolio. And one of the things I'm trying to do today is just create a portfolio approach, because maybe some of the listeners say, well, what's so exciting about a 15-18% IRR? That doesn't sound fantastic.
Anyone who says that, I mean, maybe they were original investors in Fartcoin or something, but 15 to 18% multi-year IRR, that's incredibly tax efficient. That's the stuff investors,
Yeah. And it's also the asset quality, like Andrew. I mean, you and I have all been in situations, right? One of the companies that drove me nuts back in the days was Calumet, right? The stock could be all over the place. And you literally a lot of times you're this renewable project that they did in Montana came out of nowhere and became the bulk of the value versus what you're getting. There's a much tighter range of outcomes. I mean, you're literally just owning hundreds of apartment buildings in the Sunbelt over a dozen cities. The range of outcomes is not gonna be the Calumet and the Montana renewable, right? So we like
comment. Let me ask. Let me ask you a question on range of comments. I just love, if we rewound 4 years ago, all these Sunbelt people will be talking about, hey, work from home is great for us, right? Because you have people in New York City. New York City shut down. They don't want to pay $5,000 a month to live in a shoebox with everything shut down, high taxes. They're moving out to the Sunbelt and working from home. And that kind of reverse, I don't know, but I'm curious today, AI is coming rapidly, right? It is here, but it's really starting to impact jobs, I would say. What are you hearing from these people, just particularly on the resi side, but office side too, if you want? And, if it's data side, they're just popping bottles of champagne. What are you hearing from them on trends in AI? I'm sure that it's really helpful for the resi guys in terms of screening, background checks on applicants and stuff. But I'm wondering if they're saying in the Sunbelt, hey, we're seeing a lot of people move out here because of AI. They're more remote. Or you could tell me the reverse. Hey, AI, there's 5 big centers where all the big tech jobs are happening, and it's actually really self-reinforcing the network. What are they kind of saying there?
They're not really saying much about where people are migrating to because of AI. And then if you think about the actual AI jobs, I mean, the actual numbers of people working. I don't have the exact number, but my gut tells me the actual numbers of jobs working in AI development in New York City and San Francisco probably isn't going to make a dent in the Sunbelt. You are absolutely right. In terms of screening tenants, and just making leasing a lot more seamless, where you don't need a person to kind of give a tour. A lot of these people. That's one thing we haven't talked about, right? is the bigger REITs have the scale and the ability to invest in a lot of technology that allow them to implement all this technology across, 100,000 units, right? As opposed to like, if I own one building that's 300 unit, like I can't, justify spending millions of dollars to come up with, some sort of AI algorithm. So these are structural advantages. So unfortunately, I don't have
Have they quantified how much that advantage is for them? Can they quantify that?
They have not, but I can give some.
I totally believe it exists. I'm just interested if they said if they could quantify and be like, hey, our operating costs, and I totally believe it exists. If they could say, hey, our operating costs are $20 per unit below your mom and pop who owns one 300 unit building because we bought, but I totally believe it exists. Yeah.
Yeah, no, there are a lot of anecdotes, like, like the bigger guys are not doing any paper leases. There's like literally people that are just not at these organizations anymore because not setting up paper leases, waiting for people to get a wet signature back. From a leasing perspective, you don't need as many people on site to do the leasing. Even something like leak detection, right? Having that capability. So they haven't given quantify any figures, but I think one thing that you could do is kind of look at the EBITDA margin and NOI margin of these publicly traded REITs, and they're significantly higher than most of the private multifamily deals that we've seen. And just, I think a lot of it scaled. They also own better assets, in our opinion, right? They own bigger assets. They own more institutional quality assets. So it's hard to pinpoint. I would love, maybe that's a question from, next time I see these REIT management teams. But definitely at NAREIT next year is like, love for you guys to quantify how much operating improvements you guys get from that. Let me see. I'm just looking at my notes here. Oh, by the way, just a few key notes. We went through this time period. The max NOI drop was less than 2% between Mid-America and Camden. They're currently at mid 95, like 95.5% occupancy. So despite all this worry about big surge in supply, occupancy really did not drop. I think part of it is also they're very good at kind of like pricing everything correctly so that they can target certain amount of occupancy. And they strategically decided to give us some price to be able to keep occupancy at those levels. And really all this hoopla that the other thing that's real important is that the income to rent ratio is between 21 to 23%. Very, very affordable. Think about what people in New York City pay for on an income to rent ratio. Right?
I would rather not think about it, to be honest with you.
So I think the other thing is you take Mid-America, they increased their dividend from $5.60 per share to $6.06, right? And this goes to we heard a lot of stories of private multifamily investors, investing in a deal as an LP, and then the GP used floating rate debt, the debt reset, and guess what? Distribution suspended. And we have not seen that at all. If anything, they continue to increase rent, and they continue to use all that excess cash flow to either do acquisitions, do ground up developments, and a lot of them, they're kind of in that 4 times net debt to EBITDA. They could probably take that up another turn, which is $1.5 billion, right, for a company like Mid-America, for them to either do more acquisitions or to do ground up development. So these are, these are clearly the more structurally advantageous players. And then you could buy them, in sub 25% loan to value, covers the interest 7 times, and you could do 15% owning these. And we consider we own. These are very large allocation in our portfolio. They're in that 30-40%. Our overall exposure in multifamily REITs is about 50% in one of our hard asset portfolio. And we love the multifamily asset class. And we particularly love the public valuation because of the price that we're able to get. Very large. And I continue to, I think they'll continue to, help us, perform.
Let me ask you. So every time we talk REITs, I tell you, and I'm not the only investor, and I'm not accusing any of the, especially larger cap REITs of this, but
Yeah.
REITs are a controlled company, right? They are
Yep.
incredibly difficult to go activist on.
Mm-hmm.
And for a lot of these, like, and again, I'm not accusing the large cap ones, though we could go find some small cap ones that I would kind of get some drinks in me and I would happily accuse them of it.
We got some. We got some. We'll get to some later on today.
They're more focused on growth for growth's sake, right? Growth is great for management teams. You more prestigious, you can pay yourself bigger bonuses. They're not necessarily interested in growth for growth and intrinsic value per share sake. And what I want to ask is this: the last time we did this, and again, a lot of what you said was right. You went through the stats on Avalon. You're pounding the table on this, and I think one of my pushbacks was, hey, I don't see management teams with a lot of equity ownership. I don't see management teams with, in my opinion, a lot of alignment. Yeah. Over the past 15 months, these guys were presented with a pretty interesting opportunity to create value in a lot of different ways. Did you see them, in your opinion, operating ways that kind of increased intrinsic value per share? Or have they just kind of ridden the, hey, our stocks were undervalued, let's not do anything stupid, the stock go up? And there's nothing wrong with that, but it's kind of a I'll just point to it. It's a missed opportunity, in my opinion, if their stocks were trading for a fraction of NAV and they didn't buy back shares, right? Yes, the stock worked because it's growing close to NAV, but they really could have accelerated by buying back shares a little bit, particularly when they were trading cheaper than NAV, cheaper than other acquisitions. Did you see any examples of them kind of doing things to increase intrinsic value per share?
So I think not so much. Camden did buy back $40 million worth of shares, which is, like in the grand scheme of things, it's not like, if we get to it, like I could talk about Eurofins later, which is a lab testing business, which kind of has a real estate component to it, right? And Eurofins recently just bought back 5% of shares, roughly 5% of shares outstanding in 5 months. Year to date, right? Like that's a great use of capital. They were kind of complaining that they're trading a half of private market value, and guess what? Like they just went out and they bought back 5% of shares,
right? Like,
they're exactly taking care of it, right? Now, like Camden went out and bought some shares. Now, in terms of like, so this is a great natural segue into the grocery anchor theme, right? Remember last year, you and I were at a manager's retreat, and I presented the idea. I said RYC, Retail Opportunity Investment Corp was my best idea, and we thought that it would be sold within 3 years when I presented the idea. And of course, within a couple of weeks, Blackstone came in and bid on the company. So we met with Retail Opportunity Investment Corp last year. And we thought that it was trading at a huge discount. We kind of felt that the CEO was frustrated that a lot of the buy side were asking Kroger's, Albertson, you get 8 centers that if the deal goes through, so this is right in your wheelhouse, right? The deal goes through, they have to divest to CNS. CNS has a history where if you sell these supermarkets, they tend to underperform after that. You have Rite Aid's bankruptcy, blah, 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 all these things. And I think the CEO was just kind of fed up with like all these kind of pa boy style questions that are next quarter modeling. And we kind of saw that. We saw that in the facial expression, the emotions. And this is why we get so much value out of the NAREIT meetings, right? These one-on-one management meetings, is that we could feel the frustration come through. And we're there's a good chance that this company gets sold in the next 3 years. And it's going to be worth a lot more than what it's trading at. And that, that did get sold to Blackstone. And there was, a full process. I think the price, I wish the price was a little higher, but we did very well. We it was a 15% position for us last year and contributed 4%, to the fund's performance, to the portfolio's performance. So you can't complain about anything like that, right?
But I'm also laughing because I pulled up their proxy in anticipation of this, and you said we saw that he was the frustration at NAREIT, and I am laughing because if you read the proxy, Blackstone calls the CEO on June 19th, which I believe is the week after NAREIT right then. So Blackstone clearly knew, and you were clearly reading it very well because Blackstone calls and within a month they have a full process getting kicked off. So you were clearly reading the tea leaves very correctly there.
And to anyone who's young and starting to get into investing, I would say this is my word of advice, right? AI is coming to the investment business, right? And everyone's going to be using AI. We built some in-house AI tools that have made us very, very easy for us to get up to speed on companies.
What does your AI tool do?
I think what it does is that I don't want to like go into too much detail, but I would just say that we're able to custom poll a lot of data and then create like very, very systematic outlines of like, key developments based on earnings calls and whatnot. I don't want to get into like a ton of detail because I'm just trying to protect some of that, I think everyone's going to be doing this within like the next 12 to 24 months, but in that like period when we still have some of that structural advantage, like I just like to maintain it as long as possible. But like we utilize it to get ready for a lot of these meetings, at NAREIT. But what I'm trying to say is we built AI tools. We have an in-house AI consultant that does a lot of work with us. And to anyone who's young, who's like starting out, like get, the management meetings, this is why we consider NAREIT the Super Bowl for what we do. A dozen meetings face to face. We met with them 2-3 years early, and then we can compare notes. And then we say, do they make any sense? Is there any body cues? Like if someone's like super frustrated, and those are like really, really important tells, right? We had another meeting. I don't want to name names. We had a meeting with a certain REIT where we went in. We were like super excited, and then we asked a couple simple questions to management. And the CEO became super defensive, and we're like, ooh, that kind of like cooled our enthusiasm a lot, right? So to anyone starting out new, like going to these management meetings are super critical, and I think that's somehow, that is a way for you to AI proof some of this.
Look, I think to your point, I think there's a reason that if you listen to pretty much anyone, I'm not saying it's the end all be all. But there's a reason, like the pod shop people, like if you listen, a huge piece of their process is going to these meetings and just like they're taking as many meetings as they can and they're inputting it in a big part of the job. And like for me personally, I will say like, not that I've ever gotten an MNPI, but calling a company up and being like, hey, can you walk me through this press release? And sometimes they'll walk you through the press release and you'll be like confused on a verbiage, or they'll walk you through a press release and you'll be thinking, oh, this company's going to sell for a huge premium. And you're like, yeah. Oh my God, this company wants to they want to spend all of their money on like, it's a grocery store and they want to become an AI play. And you'd be like, oh God, this is terrible. And sometimes you'll call them up and be like, look, we put it in the press release. We meant what we said. We're going to, return all of our capital to shareholders, and we're excited to do that. And we think we're going to unlock a ton of value. And our chairman is 85 and he needs to start thinking about estate planning. You'll be like, oh, this is good to go. So it's like so AI, not completely, but it's a big way. I think whether you're young or old, I think it's one of the big edges still out there, and it's a way to kind of AI proof your job.
Yeah, no, I mean, absolutely. And so I think this is like a natural segue into the next asset class.
Sure.
One of the things I want to do on the podcast is I kind of want to show people how it's not just a multifamily theme, right? Like you could, in today's environment, you could build out a portfolio, and I call it like you could build out a football team roster of ideas. And if like your most basic, your safest idea is underwritten to a 15 to 18% IRR, and then you could throw some running backs in there, and those are your offensive linemen, right? And your running backs are going to help you score touchdowns. And you could underwrite them to like 20 to 35% IRR, right? And so we're going to be a little coy because there's a couple names that we walked away that we're really, really excited about, but like we haven't totally finished the idea. We haven't like fully built our position. But the message I want to get out there is that grocery anchor shopping center, in my opinion, is as a theme is very undervalued by the REIT world. And why is that? Why is that? I think that there's a narrative out there that retail, like we're over-indexed retail in the U.S., right? And if you look at, there's a great chart where it shows that from 99 to 2008, we built strip centers. We built kind of 3% of the existing supply every single year for that 10-year time period. And then after the GFC, we kind of dropped down to maybe 75 bips. And then in the last like 4 or 5 years, we dropped even further to like below like 50 bips per year in terms of supply addition. So I think that for 15, 16 years now, this is, a industry where I think they absorb a lot of that grocery anchor shopping center in the strip centers, and they have not built a lot of new supply. Now, I think like in the interim, there's also if you're a value investor, you probably have looked at Seritage, Sears, and the Class B and C mall, right?
I'm laughing because I looked at Seritage last week because they paid down some more of the term loan, and you and several others have always been like, "Ooh, the assets are bad there." And I was like, "Oh, the term loan's starting to get paid down. It's getting to the last assets down here."
Well, I full disclosure, I think we had a 1% exposure to Sears or Seritage. Like we swing traded, and then like we just been like not been involved in it. The Class B and C mall, regional mall, it is just a really tough asset class to be in. But this is grocery anchor shopping center. So imagine 100,000 gross shopping center, grocery store, and your Chinese takeout, your pizza shop, maybe your Pilates, and the urgent care. And I personally have a ton of experience, right? Because like I grew up in a family business where we were the Chinese takeout in the grocery anchor shopping center. I was a fishmonger in the supermarket, so like I know this asset class very well from being a tenant in these spaces. And so there's a historical backdrop where in the last 15, 16 years, annual supply addition is less than 1%. It's been running at about 0.5% per year. So this narrative like over retail has actually, I think that's getting a little long tooth. I think you have the rise of Amazon where everyone thought Amazon was going to kill every single retail concept. And then it turns out, hey, your Chinese takeout, your pizza, your Pilates, if anything, some of the older concepts, your stationary store, like there used to be like a stationary and lotto store, like in a strip center. Those have like kind of come out. You get more boutique fitness. You get more, kind of like retailification of healthcare. So your MRI, your radiology, your urgent cares, right? Of your physical therapies, and I think what is like concepts come and go. But what is timeless is it's convenient. You pull up, you park, you go in, instead of going to a big hospital, big medical complex where you pull in, you don't know where you're going, right? So what's happened, particularly in the Sunbelt, is that there's been a lot of immigration, but they haven't built, because to build one of these, you need 10, 15 acres minimal. And if you're in an urban infill in Dallas, Fort Worth, like in any of these Sunbelt cities, if there is one, that's existing, it's hard to find another 10, 15 acres that are just sitting there in like a really busy intersection. And, we talked to some of the grocery anchor shopping center REITs, and they said that to justify building a competing grocery anchor shopping center, rent will have to double what their tenants are paying right now. So you get this, and I think that most of the market participants are like, have not kind of figured this out, right? So we're like sitting there with scratching. Okay, you could buy, like, if you want beta exposure, you could get Regency, which, like, we don't really, like, I just want to throw that name out there because, like, people really want the exposure. Regency is a strong candidate, generally considered to have the best assets, the best management team in the space. Of course, like, you have to pay up for that, right? And most of the Sunbelt grocery anchor shopping centers, they're grown NOI by 4.5% per year. And a lot of them, particularly in the Sunbelt, when they renew the leases, they're able, they usually have like 3% rent escalators. And then when they renew the leases, because a lot of people move to the Sunbelt, right? Rents have gone up, but because there's usually, usually signed 7-8 year leases, a lot of them have not rolled off, right? Especially multifamily has repriced on an annual basis. So a lot of those rent growth have not. So when the leases expire, they could usually increase it anywhere from 10 to 20% for renewals. And on new leases, you're getting 20%. So you naturally have a 3% escalator plus, these like 10 to 20% on renewals and new leases. It like that algorithm, that growth algorithm, becomes a really nice 4.5% NOI growth per year on something where if you're able to buy at a 7, 8, or even 9% cap rate, that becomes a really nice little algorithm, right? And the occupancies are on par with a lot of multifamily asset classes. They're in that mid-90s occupancy. And this is different than, regional malls. This is different than like a power center. Because on a power center, if you have some sort of major bankruptcy like a Party City or Joanne, like you have more exposure to these troubled tenants. But the grocery anchor shop, like, the Krogers of the world, the Trader Joe's of the world, they're not usually going out of business, right? So this as an asset class, there's like 2, 3 names that we're like really excited about. We're not ready to talk about today's podcast, but like I want to throw this theme out there that this is a really, really interesting theme that I don't think the market, is really fully pricing in. And there's probably a reason why, if you think about, like, Blackstone is kind of known for, when they see a shift in the market, they tend to be the one who, like, identifies as like a theme early, and they just went out and bought ROIC at essentially a 6-1 cap rate, right? So if you kind of like piece everything together, now granted, like, that ROIC portfolio was 97% occupied, like super high barrier to entry. That's a very, very unique asset. Like, everyone that we talk to in the private market, they're like, it's almost impossible to get that West Coast exposure. And then, kind of like, in one deal, Blackstone could do that. And I think Blackstone got a really good deal at a 6-1 cap rate. They could, like, keep growing NOI, call it like 4% per year. Like, that math just works really well if you're financing with a 5% in that 5% or even like a low 6% range. So that's a thing. Like, we kind of view that as running back. We got a couple names. Not ready to discuss today, but, like, we got one name we're underwriting to, like, the mid-30s IR and like a 3-year hold. I think, either they get sold in the next 3 years, or they kind of get kind of just, like, naturally, like, grow into a certain scale, and, like, some of the overhang gets cleaned up. And then, but, like, there's others that we, like, underwrite to, like, the mid-20s IR over 3 years. So that's like a theme that we really like. And so we kind of view that as, like, the running back.
Let me ask you just quickly. You mentioned underwrite. Again, if I thought back to our last one, or even right now, the big argument is, hey, these guys are trading way cheaper than their private market values. Now, you had something like resale opportunity, ROIC, that got sold. But have you been surprised by the lack of kind of just full company takeouts in the public markets? Because if I thought back to, like, the financial crisis, what did you always hear? Hey, if you had REITs that were trading below private market values, a private equity firm would step in, buy the whole company, and liquidate it real fast, and kind of realize that. Have you been surprised we haven't? We had our. I can't really think of any. Have you been surprised we haven't seen more?
So in this case, in the grocery anchor shopping center, Kimco did a stock for stock deal. They put out another one, and then there's I can't. It's like Urbito something. I can't pronounce that company's name, but there's been 2 deals. So there's really been 3 deals. Like, if you think about, like, how many deals been happening, you got Blackstone buying out ROIC, you got Kimco buying the other company, and then there's, like, a third. And on the stock for stock deal, it doesn't seem like the implied cap rate is
it's not really a takeout, though, right? That's more a synergy play if two people merge.
And like, we wouldn't mind, like the companies that we have in mind, like, we would not mind it if we get, say, a 50% premium, and most of it is in stock from someone that we think is also cheap, right? Because then we get to roll that into the acquire in a stock deal.
I love just the casual. Hey, look, 50% premium, all stock in a company that's cheap. We'll roll it. I love that for all of my companies too.
No, because like, Andrew, here's the thing: like, you get 2 sets of SG&A, and then, like, again, like, you think about, like, where do we exist in the ecosystem versus, like, the bigger guys, right? The bigger guys want to buy $5 billion REITs. So if you take, like, two of these smaller ones, and one's, 2, I'm just, like, doing some arbitrary math, hypothetical math, right? One's a $2 billion, one's a $3 billion. Stock for stock merger, we get a 40-50% premium, we get stock in the bigger one. Now all of a sudden, actually is a $5 billion. Now, like, the bigger, REIT funds could say, hey, this is liquid enough. This, like, we could own this, et cetera, et cetera. So, like, I think there's just, like, a lot of ways. And we've seen 3 M&A in the last, like, 2-3 years. Like, I think that's, like, fairly active for the REIT space.
Let me, just while it's top of mind, I want to hear, so you've walked through kind of, like, your offensive line and your running backs, and I want to hear about your wide receivers in a second. But let me just, before I forget, ask this question. Office space in general, and maybe San Francisco in particular, but office in general, I have been surprised by how positive I've heard people overall on offices over the past year. I'd love to just ask you, like, kind of, what are you hearing about office space in general, and what are you thinking about kind of office REITs in general?
Yeah, I mean, I think that you gotta like bifurcate it into Class A versus, like, Class B and C, right? And Class A, and our next idea is an office idea, Alexander's, which owns a Bloomberg global headquarter. I think would definitely like. By the way, kudos to your guests who called for NATO, right? Like absolute bottom, absolute bottom ticket. Bottom tick that idea. Like great call on it. We bought some Vornado preferred at that time with like 11.5% yield, like 45 cents on the dollar. We made Alexander's, which is Bloomberg headquarter, a 12% allocation earlier this year because we had a view that like we're past the office is debt narrative. Okay, we're like we do believe now, like the Bloomberg global headquarter has some very, very unique characteristic. It has a lease that runs out to 2040. You got Bloomberg as a tenant, right? Like from a credit perspective, and the fact that it's global headquarter, it's not some like satellite office. So that's a very, very unique asset on its own, right? So we need to mention that. But I do think that like if you own Class A office building in New York City, I think we're past the narrative that office is dead. Like for the Class A Class A well located office buildings, right? The Class B and C, I think, are still very troubled. But what I do see is outside of New York City, the Class B and C. Now, of course, like you and I talk about net lease office properties, and our friend David Bashian, like there's a few people who like absolutely nail that trade, right? And you could very easily see that at the right cap rate, these Class B and C offices transact. There's a market for it. I think what's changed is pricing, and then I think that anyone could kind of like run a DCF on, hey, if you got 12 years left with a good credit tenant, right, you could kind of like run that DCF, and you're getting at a cap, right, you get all your money back, and then like what's the residual value of that office at year 12, right? Like it becomes easier, and it's actually one of the less interest rate sensitive asset classes out there right now.
Yeah, it's funny when I'll disclose I have a position in lot. It's funny when you buy something at a 20% cap rate, it doesn't particularly matter if interest rates go from 5 to 6 or 5 to 4. You're kind of just hoping that those assets don't get crazy worse. Last quick question, and then I'd love to focus. We can talk more Alexander's, or we can talk about HPP. You and I are talking. It is June 16th. Last week, Cohen and Sear, who you mentioned, backstopped a deal. HPP at the time. Now people can go look the whole thing up, but this was a company that has lots of office exposure, particularly San Francisco. Stock's been hammered, tons of leverage. Last week, the stock's trading at roughly $2.50, $300 million market cap. They announced a deal to raise $600 million in equity. And I was just curious, did you have any thoughts, any reads on kind of what happened at HPP? Did it bleed into the sector? Any HPP specific thoughts?
Not a ton. I mean, we kind of had a tiny amount of like, I think at the time we bought it was elite, like it was just like a little call option on it, just like to kind of see like if fundamentals improve in San Francisco, that it's like a way for us to get some exposure. We've seen when SL Green, this goes back like to 2009, right? SL Green at the time was down from like 130 all the way to like $10, right? And they did a tiny little bit of equity offering, maybe like increase share counts by 10, 15%. Now, depending on who you ask, right, that's either a lot or very little, right? Obviously, in this case, if you're going to increase your share count by more than 150%, I don't know what the exact number is.
I think it was literally doubling the share count.
Tripling the share count.
They offered almost 2x as many shares. So I think it was tripling the share count.
I mean, obviously that stays off like any sorts of like near-term bankruptcy. But like at the same time, like when you triple the share count, you kind of hold like an AIG or Citigroup, right? Like you massively like dilute the future upside.
My friends who I talked to, that's what's interesting. So I was like, hey, it's kind of interesting because if you look at it as a call option, you've really extended the call option by raising that much cash. But at the same time, all my friends were saying like, hey, they've got a lot of San Francisco. San Francisco's kind of turning. If you do a NAV, because it's so levered, like, yeah, there's huge ranges, but I kind of think the NAV is $10. When you dilute yourself by triple, well, NAV goes from 10 to 450. So like there's all these pulls, and then it's kind of like, hey, Yeah, maybe it's better buy on an EV today, but I was kind of playing for if I'm right, I'm getting a triple. So it was
Yeah.
just weird, but yeah, it was a crazy situation all
Well, I
around.
mean, and also like keep in mind, I mean, this is a REIT that was buying back shares at like 21 and decided to like invest in the studio business, and I don't know. I mean, like if you look at some of the Mid Journey videos out there, like it's really making me think like man, like studios like Mid Journey, like you look at what the generative AI can do with video today, like I'm like
Listeners don't even realize we're not even taping this podcast. This whole thing was AI. We just said make a podcast with Andrew and Bill, and
and so like when you get again like we don't know HPP. It's a name that's been, we've had a lot of people ask us for opinion. We never really had a ton of exposure to it, never felt comfortable with with like the balance sheet, et cetera. And I'm glad, like, we got like a tiny, maybe like 10 basis point in leaps in it. Like nothing that like kind of like moves the needle too much, right? If we're wrong on it. But to kind of what you were saying about like management and incentives, right? And again, I don't know this management team that well. I think that when you buy back shares at 20 and then you issue shares in the mid twos, and then you're kind of doing it and not giving people that $10 upside, you're doing it kind of like let's just call it what it is, like likely to just preserve your job, like you're like you're kind of doing everything wrong, right? And this is why um like if you look at Clipper, which is like has been like this like frustrating ownership experience for us, because of so many things that's happened with like rent stabilization in New York City.
yeah,
To that team's credit, like they continue to pay out the dividend, and some people may argue that, hey, like, why don't you cut the dividend and just retain it, rebuild your balance sheet. They can continue to just like kind of execute. And look, trust me, like that's a frustrating company for us to own, but like this management team has actually like managed to like not really dilute, right, much, and it like has kind of retained where if people started believing in the story and they cut rates a little bit, like Clipper could potentially be a $10 stock, right? And we put that in the wide receiver bucket. So that's kind of a long way to say, like, we don't have strong opinions on HPP. It's always been one of those names that people have reached out to us and told us, like, we even got like a short pitch from it. Just shout out to Waterboy on Twitter out there. I kind of thought like it was neither great long and great short. But everyone follow like Waterboy Capital. I think it's Waterboy Capital, but it's Waterboy. He sent me a short pieces on Hudson Pacific, and he's been right. So but not a ton of like generally great insights on HPP, but like I think the corporate governance does think, yeah.
It was so interesting because again they tripled their market cap, and yeah, I was just looking. What about what are some other wide receivers you're interested in right now?
I mean, I think the two wide receivers is, I think Clipper is a wide receiver, and we own a little bit of Seaport. I think Seaport is a wide receiver. You may think it's a running back, like.
No, I'll disclose I have a position in Seaport as well. I did the podcast with Chris Waller maybe 3 months ago, so people can listen to that. But I love Seaport.
Yeah, I mean, I think Seaport has a ton of upside. I think I'll put it this way: I've been in enough of these like land rich ideas, right? Like these like asset rich ideas, and where I just kind of learned that like there's a certain volatility, there's a certain way that they trade, and when you don't have this like nice steady dividend with like kind of like what I've been consistently saying about Mid-America and Camden, where they're kind of like super anti-fragile, cover the interest payment 7 times, and there isn't like a story on like can they stabilize the Tim building, like turn around, and we're my family and I are going to spend a ton of time in the Seaport this summer, right? Like we're gonna like we're tracking.
I'm going to come down with you. You let me know when you want to go. I've gone to my wife. We did her birthday party at the lawn club, so I know the area.
Yeah, I mean, hey, croquet game at a lawn club.
Hey, do they have croquet there too?
Yeah, I mean, lawn club. I'm pretty sure they got like indoor croquet.
Okay, I don't remember them cooking, but we did the giant beer pong,
Okay.
obviously, and then we did can jam. I was having so much fun with that. We did a ton of stuff. It was a blast, man.
Yeah. Yeah. No, I
I,
mean,
I will I will
yeah.
say you go to lawn club. So we went on a Friday night, and I'm
Uh,
sure people want to hear. People
mm,
want me to regale them with the stories of my wife's birthday, but we had a ton of fun, and it was reasonably crowded. But I will say we were like Friday night, and I was kind of I was talking to some friends who were there, who some of them are public market investors, and we were like, hey, I don't know if this is the bull case or the bear case for Seaport, where it's like
yeah.
this is a ton of fun. There are people here, but if we were Midtown, this place, if we were at a Swingers, and Midtown Swingers is a putt-putt place in Midtown for
Okay.
those who don't live there. One time I put a charge for, my wife was away, and I put a charge for Swingers on her credit card, and she called me up and was like, hey, I'm out of town for a week and you're spending $200 at Swingers. And I was like, no, it's putt-putt for me and five guys. It's not,
Yeah.
we're not going to the Swingers stuff. Unrelated. We
Yeah.
were saying this place would be out of this world packed, and
Yeah.
that's
Yeah.
kind of, it's like a bull case that we were having fun and it was really nice. A bear case, it wasn't completely full. A bull case that, hey, if they
Yeah.
could fill up the rest, and all of this like really got the thing going. But yeah, I don't
Yeah.
know what I'm saying on Seaport at all. Yeah,
No, I mean, I think the like I followed that story for a really long time, right? And I got kind of anecdotes going back to 2017, 2018. And I think a lot is gonna really, depending on the new CEO, how he's gonna reposition, like how he's gonna drive traffic to these assets. And like there's a case where, and I mentioned some of this like on Bill Brewster's podcast. I think how they drive engagement and traffic, because with more traffic, that's how you're able to get the operating
yeah,
leverage in the
yeah.
restaurants and all these. And there's, like, I mean, that could be a 2-hour conversation, right, podcast on its own, between like you, me, and Chris Waller, and talk about like what we're looking for, et cetera, et cetera. The asset values are totally there, right?
Look, I do like what you said, though. You were like, hey, I've done a lot of these land rich ones, and the volatility is there. And you're 100% correct. Like with Seaport, I kept being like, hey, there's, $18 per share of cash. It can't trade for too far below 25, just because you start getting to the cash covers it. But you're right. Like people don't care. It's small cap, basically controlled company. People don't give. They don't give one fudge how much cash on the balance sheet. They care about, they're seeing articles on 10 building is burning $100,000 a day in cash flow, and
Yeah.
there's not a lot. And I think you and I both had the same thing. Yeah, you haven't seen a crazy amount of movement, but that's because it's real estate in New York City. Like it takes time to lease these things up, and I think to get the Meow Wolf lease done and to
Yeah.
get to 50 ready, like I actually think they're moving pretty darn quickly.
No, I agree with
Yeah.
you. I do agree with you. I think I have one thing I have noticed is that I think when they decided they were going to do the spin, give like our listeners a little bit of context. Like I used to run into the former combined company CEO, and he would tell me like all the weekly operating stats and whatnot, and I'm kind of like, you're probably like too engaged, like because he's running a huge organization with like all the NPCs, et cetera, et cetera. And then here's like he's telling me about like weekly restaurant sales like at the Seaport, right? And I'm kind of like, you're probably
hit
like,
him in the chest every time he saw the reports.
no, he was actually like really bullish, right? Because like it was one point like it was like trending in the right direction. And then I think like once they decided that they're gonna spin that off, right? Like you see like a lot less involvement. It's kind of like that's probably someone else gonna come in and fix that, right? And I think that what they've done here is right. Like the MPC assets, the War Village, the Woodlands, like the Summerlin assets, that fits in well in a different box, right? And then the Seaport is like a whole different. I actually think that given all the press releases, and I also actively follow them on Instagram on their on the concert series, like they're trying to do more with the concert. They're trying to host more concert events, which will drive more foot traffic there, and you need people there. You need people to spend money there, and I think like it also kind of like builds a better brand, right? And so we're tracking it very, very closely. Again, we view that from like a portfolio allocation perspective. Again, going back to the Mid-America Camden, FRPH, those are offensive linemen. They're like a big part of our portfolio. We have like other, multifamily names that in aggregate makes up 50% of the portfolio. The wide receiver Clipper and Seaport are kind of like 2 to 3% allocations each. They're much smaller. They have more torque, right? They have more torque, more volatility in the names. And then, like the grocery anchor shopping center is probably going to be a big part of the portfolio as well. We have, another like unnamed multifamily because we're trying to like build a position where we think that's probably going to get taken out, and where the IR is going to be higher than the MACPT. It's a slightly smaller company. It shall remain unnamed right now, but we're do more underwriting on it. So we kind of look at everything from a portfolio perspective. And Andrew, this is not the case before 2022. Before 2022, like we may be able to find one or two really, really good high conviction ideas. And in today's environment, we could build a whole team. We could build a whole roster. And maybe like, one thing I promise is, Andrew and I talk about this. I'm like, hey, like, it'd be really fun to see if I could like build the roster, right? Like build the whole full team roster of names like on this.
Who's the quarterback? Who's the quarterback?
I guess you call me the quarterback because I'm calling the plays I'm making, or like I'm the head coach,
you like the head coach.
Yeah. I'm like the head coach. I'm like flexing the exposure up and down, right? But want to talk about some special teams?
Yeah, let's hit some special teams.
Special teams. I think I think Dream Residential is really like this is really simple, right? Early this year, there's a tiny little Canadian REIT that came out with a press release that said we're exploring strategic alternative, which everybody in this business knows that they're looking to sell themselves. So Dream Residential, at the time, I think it had a nice run from like high 6 to high 7s. And we're looking at it. They have a published NAV of like 1330. And we're able to buy this at like 770, 780. It's very illiquid. His name's like very low, like a full disclosure. Okay. And I'm like, you got a $13 NAV and we're able to buy it at 7.7. And we like got on the phone. We called all the brokers we even tracked down a broker who sold these assets to the REIT before they went public. And they knew everything about all these properties. So there's 15 properties, there's 3 different markets, Class B assets. And we were buying at like an 8.7 cap rate. Today, there's 7.8, right? Today, like the US dollar denominated units is 9.15. The NAV is 13. I think there's going to be slippage from liquidation costs, et cetera, et cetera. Maybe you get $11.50, $12, right? From an event-driven perspective, that's still like a pretty good, nice upside from like 9.15 that you're buying today. And again, like you're buying multifamily at a 7.8 cap rate. Now, granted, this is not Mid-American Camden's quality, right? But there's always a buyer out there. Andrew, what I learned about multifamily, why I was so bullish on it, is that you could be Class A, Class B, you could even be like Class C, all right, C plus. Like we don't really like to go into Class C. There's like a buyer in every local submarket for like every spectrum of age, because the older assets, the buyers could say, oh, we're going to do some sort of value add. There's like a value creation story that they could tell, right? So very simple. Dream Residential, they hire TD Securities. They're paying a monthly dividend, an annualized rate of roughly 5%. So you could buy this and, probably gets done in like 12 months, because a portfolio like this should be able to move very, very quickly. And I think at the cost that we were buying it, we were modeling to like a 40 to 60% call, like 1 year total return, inclusive of like a 5% annualized dividend, right? Like we would have never found like an opportunity like that a few years ago. Remember there was that New York City REIT, New York REIT liquidation a few years ago, and everybody was like, I think it was like literally got 5% cap rate for Class B New York City office, and everyone, like every hedge fund was like in on it, and then like fast forward to today, you could get like a 8.7 cap rate on multifamily liquidation, right? And frankly, like maybe some of the long-term listeners have asked, hey, like, what about Aimco? Like, frankly, like we kind of sold some of Aimco to like redeploy into this name, because again, like one of your podcasts, you talk a lot about, hey, like in a market, it's all about, if you got something that is a 20% IR and you find something that's a 40 to 60% IR, you should get out of one to go buy the other. And that's kind of like what we did here, right? And now that this has traded up from call it eight, low eights, 810 was like kind of our average. Like it's gone up to like 915. There's still like decent upside. If the spread gets a little tighter, and then if Aimco trades down, we may swap back and forth, right? Like it's all you're just running like forward IRRs on a lot of these because
and exactly forward IRRs and then likelihood of the deal going, because
exactly.
If it's at 12 and you're like, hey, it's 50-50, they sell for 13, then you don't want to be there. But if it's at 12 and you're like 100%, like the LOIs are in, it's a different story.
Yeah.
I have a quick last question because we've almost gone for an hour and a half, and I'm going to have to wrap this up. I have one last question. Somebody asked this on Twitter, and it kind of struck me. Why do the real estate ETFs suck so much? Like XLRE, which is the biggest one.
Yeah.
American Towers, which is a historic multi-bagger, fine company. American Towers and Prologis, both great companies, great historical returns. They're 10% positions. And if I wanted when I think of real estate, I think of the stuff you were talking about, right? I think of self-storage. I think of office towers. I think of multifamily. And I think of they're actually not that big in the real estate REITs that I'm really familiar with. So why do the real estate REITs suck so much? Are there any that are good?
Yeah, I mean, we really have not found the one that we track a lot is the Vanguard ETF. The tickers VNQ.
Okay, I've looked at that one too. Yeah, I think it's very similar to XLRE.
Yeah, if you look at that weighting, multifamily is 8.8% weighting in that one. And if you look at our portfolio is 50% multifamily.
Yeah, and multifamily is one of the ones. If you were like, hey, what do you want to read? I'd be like 40% multifamily would be fantastic. Thank you.
Yeah. We're even more. And if you also think about when a high net worth individual or family office want exposure to multifamily, what exposure to real estate, what are the asset class that they're most likely to invest in? Multifamily. It's not like most family offices or high net worth individuals are not going to be, get me into that data center or get me into that tower, get me some tower exposure, right? These are remnants of the public REIT market, where I think their market actually I'm not 100% sure what exactly. I think it's market cap rated. So some of these your Prologis, your cell tower, your data centers. They're market. I think they're market cap rated.
It's definitely market cap weighted, which is why it's happening. But it's just funny to me, because to me, maybe it's just a sign that the market's underserved and we need to go launch the Bill and Andrew's Excellent Adventure multifamily REIT ETF. But I just I'm just so surprised, because that's what I would think people would really want to invest in. They'd want to invest in hey, I get a monthly dividend from a multifamily and triple net lease power centers or whatever, and you just don't get that. You basically get American Tower, Prologis, and Equinix is what you get when you buy one.
Yeah, no, exactly. You get Equinix and exactly, you get Equinix, the Cell Tower REIT, and Simon's a big component of it. Retail somehow is 12 or 13% of it, and a lot of it is Simon Properties, which is regional,
which malls, is fine. Right? Class A malls, malls, it makes sense. That's the type of thing. Probably, but in your head, when you think real estate, you think local multifamily is a big one you think of, and as you said, grocery stores or those are the two big ones you think of, because that's what the rich dentist family is probably buying, and you don't get that in public markets, and there aren't really REITs. It just feels
and I think the REIT ETF has a lot of issue. One of my friends, Hopcraft, have talk a lot about that, right? Which is when you and I first did the podcast in late 23, we were pounding the table on multifamily, and we made that, I think at that point, something like 60-70% of the portfolio was in multifamily, and that's worked out well for us. And my understanding is that you the ETF kind of have an issue, but then I think some of the bigger Cohen Steers and Nuveen, they're kind of very closely track a lot of the ETF and kind of the overall cap rated index. So you're not going to find those mutual funds, REIT mutual funds, like having a 34, like a 20, like, we're at 50% residential exposure in the portfolio, but like they're going to be, probably below 10, right? And you're just like not going to get that kind of exposure. But we love, we love what we're seeing in a lot of these like simple, easy, like for us to understand, well, like this makes a ton of sense. Like every doctor, every family office would love to get exposure to some of these grocery anchor shopping centers and multifamily.
It's one thing that jumped out from our first conversation, and Hawkins and I have talked about this too. Like, look, I would always say, hey, public markets, it's a discount to private markets. That's not always been the case. If you fast forward, if you rewound 20 years ago, public markets traded at a premium to private markets. And that was because you had this liquidity. You weren't at risk of the B REIT. Hey, I want to redeem and I can get 2% of my money out every quarter for the next 20 years. You simple taxes, you could sell, buy, liquid like that. That theoretically should trade for a premium. So it's crazy to get a discount. Bill, it has been an hour and a half. I have one last question. I have to wrap this up because I got to go. I got the number one dad hat. I got to go take care of something at some point. One last question before we wrap up. This is definitely past podcast number 5. You've got the Yet Another Value podcast t-shirt, right?
I'm not sure if I got a t-shirt again.
Oh, okay. Well, we'll correct that real quickly. But that's the most important question this podcast. But Bill Chen, Rhizome Partners.
Andrew, if you don't mind, if people want to reach out to me, Bill at rhizomepartners.com. And then we also write
I like these ones. Yeah.
Yeah. We write memos, we write kind of like our thoughts. We have a distribution list. So if you email hardasset2023@gmail.com, we share our thoughts. We write memos. Some of them are even done on a typewriter. We love to get a little more followers. And what's great is, the due diligence that we did on Dream Residential actually came from one of our followers, and we were able. So that's something that we love to build on, right? Like if you are a private GP and you want to, that we can connect with and get some on the ground like local knowledge, we would love to connect with that and full spectrum of people who are interested in following our content.
Perfect. Yeah. Well, hardasset2023@gmail.com. I get those. They're infrequent, but I really enjoy them. So Bill Chen, I'll follow up over email on the shirt situation, and looking forward to having you back on in the near future.
Awesome. Thank you, Andrew.
Everybody. A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.